Hi, it's Lee and welcome to the Tesla Economist. Alright, it's hard to ignore what we just saw in the markets. After we'd just been hanging in there all that time to have finally broken $300 again, and then starting to run and beat the market for several consecutive days, it felt like we had our momentum back, even getting not too far off the pre-split $1,000 price. Yet we got hit again. Yes, the Fed went through with the 75 basis point rise. But the concern is that they won't stop there, and there's more to come. They seem determined on doing what they can to squash inflation. We have got to get inflation behind us. I wish there was a painless way to do it. There isn't, says Jerome Powell. I know it can be a bit scary right now, but I think in reality, the Fed is just playing game theory with the economy and doing what they can to buy time for when other areas of the economy catch up or either settle down. That will also alleviate inflation, like the war, supply chains, or wage rises. And perhaps we can get into that in another video. Now, a lot of you comment on the fact that the macros are now in charge of the stock price. And yes, to an extent, you're totally right. The macros have compressed the PE ratio. The macros have made investors short-sighted and less patient to wait out growth stocks. The macros have made higher dividend yield stocks relatively more valuable. The macros have increased bond yields. And investors are more interested in cash now rather than investing in stocks, thus taking money out of the markets too. All of this is not great for Tesla. However, in just the last couple of years, Tesla is not the same stock it once was. It's since turned into a very profitable company with crazy margins, more demand than we ever expected, and massive plans of increasing production in the short and long term to the extreme. But the market still looks at Tesla as a long-term investment and thinks things like FSD or robotaxis are priced into the stock, thus justifying a massive trillion-dollar market cap at times. But the market doesn't have as much faith in Tesla as us. We do the numbers, and we see Tesla hitting much higher production rates much sooner than anticipated. We see Tesla achieving these rates with higher ASPs than the market is predicting too. Tesla may have recently started ramping up their standard range Model Ys, but they aren't close to ramping up their long-range versions, which will have an even higher ASP and even higher margins again, if that was even possible. Granted, these long-range or higher-cost Model Ys are dependent on the 4680 cell ramping too, but even without that, Tesla still has some great growth potential ahead of it. But Tesla and Elon fully believe in the fact that they will achieve high-volume production with the 4680s, so much so that they built the largest factory in the world in order to do so. That's just the macros that have suppressed the stock price by reducing the PE ratio. However, we may also have to be concerned about a recession too that might actually have the potential of reducing Tesla's earnings, by which I mean they may not grow as fast because there is the possibility they may have to reduce prices to increase demand or slow down production to meet demand at current prices. I would say the former is more likely. Okay, so PE is suppressed. And now if Tesla do break out and their earnings hit what we do expect, it may no longer take us to $500 or so that we might have expected, perhaps early next year. If Tesla double their profit of a PE ratio of 50, the stock price becomes 4 times higher than where it would be with e.g. a PE of 25 initially. That's a big difference. I guess what I'm trying to say here is even if Tesla does do what we expect, or even close, like doubling their earnings, it's no longer enough to see equal gains in the stock price due to this PE compression. But this is investing. This is why we say you need to hold for 10 years or so. There was always a very high possibility of hitting a recession, holding your stock over that period. Remember, investing is not like interest in the bank. Your stock doesn't simply increase 1% or so every month consistently. No, you can lose 20 or 30% in just a month. Equally, it could even double in other months. But the longer you hold, then the higher chance next time it drops to 20%, then you might be up 5 or even 10 times more than today. And this is what being a good investor is about. It's having that conviction in the company even during these difficult times so you can hold for that long. And there may be more difficult times to come. It might be another repeat of Q2, where we had macro issues and internal issues. We might see energy shortages in Europe, which might result in potential shutdowns in Berlin perhaps, or consumers less enthusiastic to purchase a vehicle that runs on electricity. Demand could drop due to being a tougher recession and higher interest rates. Again, this is also what investing is like. Well, this is just what business is like. Business doesn't always go smoothly. It's incredibly tough to be in business. Tesla are doing remarkable considering how many components go into their vehicles and how many suppliers that they rely on and depend on for so many parts that are essential for the car. They do an absolutely fantastic job, but sometimes even Tesla can't control everything. Bear in mind though, the stock price isn't even close to as low as we were earlier this year, yet we held then and we need to hold now. We dropped to about $200 earlier this year. We held through those times. Hey, we even bought more or leveraged higher. We were right then. Tesla has since crawled its way back up from there, and here we are again. Not to mention only just over a year ago, when we dropped below $200 even. Think how much Tesla has progressed since then. Next up, we have Q3, which is a much more realistic quarter for Tesla, and will remind a lot of investors just how truly profitable this company is, which they might have forgotten after the disastrous Q2, and need some more perspective. We're about to see Tesla's most profitable quarter ever, and this was despite losing a few weeks in Shanghai too, for line upgrades and various other reasons. And then we might see an even better Q4. Then next year, Tesla's vehicle prices drop $7,500 in the US, so Tesla will need to really hope they can get their supply increase for that. But for those of you concerned again about demand, it will not be an issue in the US. And I know a lot of people are speculating about demand issues in China right now, but Tesla haven't lowered their prices yet. In fact, there's a possibility Tesla are just trying to push more domestic sales in China as it's the last month of the quarter and want to realize those sales rather than them being exported and the vehicles produced not counting for this quarter. Remember, Tesla export a lot of their China production, or have in the past, mainly to Europe, because it's such a big market. And even now we have Giga Berlin, it's not producing enough to serve Europe. In addition to that, Australia has opened up too. Tesla tend to push more China domestic sales in the last month of the quarter. And don't forget all the other exciting things on the way with Tesla. AI Day in under a week now. Sure, the sentiment from the market will be more depressed no matter what Tesla shows us then. But again, this is what makes us great investors, that we can see through all that and still be excited for this company and the future it has. Whatever recession occurs, we will get through it eventually, and Tesla will be left standing. Tesla is a vastly stronger company than it once was and can weather any storm better than any other auto company. You may think that the Chinese might have a better chance as their vehicles cost less, but remember, they're not profitable. So if they lose sales, then it hits them much worse than Tesla. If Tesla's demand drops, it means Tesla makes less profit by reducing prices. If others' demand drops, it means their losses increase significantly. Meaning if things do get that bad, then it just means that Tesla come out better on the other side, with fewer competitors standing and a larger potential market share for Tesla, or essentially more demand. Good for Tesla, but potentially not so good for the transition to renewable. But anyway, like I said, the market has still valued Tesla with perhaps about half the growth it anticipates over the next year or two. And even with a low P/E ratio, Tesla may still end up generating about twice the profits the market expects. Remember though, the stock is still higher than it was at the start of the month. Just a few weeks ago, we didn't feel this down then, and although Q3 deliveries may not move the stock much, I still think the market will be surprised by the extra margin we might see when the financials come through. But not just in gross profit, due to all the price increases, but also operating margin and net profit margin, due to the economies of scale we should start to see kicking in more so too. I'm not saying it'll be twice as much profit than the market is expecting for Q3, but I think it will surprise most. I can't wait to get those delivery numbers so I can work it out. I know it's kind of upsetting that it felt like they were starting to build up some steam again and then get hit down. But we've been here before. What happened last time? You picked up some more shares perhaps. Of course, I'm not suggesting you should this time. I don't know your financial position. And if you need to sell some shares to make your mortgage payments, then that's understandable too. So be sure to stay vigilant. But for those of you who are doubting your conviction, go back to your mantras and remember that even if the auto industry is suppressed in a recession, which it is, being a cyclical industry, that the EV industry is still growing in demand and supply. Remember that Tesla is by far the leaders in that industry. None of the legacy autos are catching up in quality, features, range, or performance, and none of the Chinese EVs are catching up on build cost. On this channel, I do more than simply explain how I see this company, but I also offer support in the downtimes too, which it feels like there have been a lot of lately. But eventually we should get some wins as well, as Tesla is not going anywhere, but some of the competition likely are. Investing can be emotional and draining. You may think it's easy not to sell and just to hold, but you don't honestly know until you get put through these sorts of tests. Thanks for listening. Please hit the thumbs up and subscribe. You can follow me on Twitter and talk to me on Patreon.